For more reaction to the jobs number this morning, we're always pleased to be welcomed by David Kelly, JPMorgan Asset Management Chief Global Strategist. David, welcome.
Good to be here.
I was thinking, as Sarah mentioned, that the period last couple of years where the revisions were consistently up. Mm-hmm. Now we're in a period where they're consistently down. Does that move the needle directionally for the Fed?
Well, I hope the Fed realizes where we are. I mean, what we're doing is we're just settling in to a slower expansion. That's all that's going on here. There's nothing in the data here which rings any alarm bells which says recession. But psychologically, the economy is sort of in a delicate position here, because if the Fed were to panic and cut 50 basis points, then suddenly people would start pulling back, and that's the danger. And that's why I think it is so important for them just to go 25.
So you think 50 would be self-fulfilling in some ways?
Oh, yeah. And I think, in fact, that's really the problem. It's a very delicate thing bringing down interest rates, because if you bring them down quickly, the psychological negative of doing that probably overwhelms any positive from actually a lower cost of borrowing money.
On the other hand, they are worried about it getting worse. And if we are seeing a soft landing, then there's a line from a soft landing to something worse. Yeah. More deterioration into a recession. And if they are seeing their policy as over tightening at this point, why not just go a little bit bigger and start the process?
Because this economy runs on confidence. And what you've got to do is maintain that confidence. And the message from the Federal Reserve should be, yep, the economy is very healthy. I mean, it's kind of like my doctor. These days when I see my doctor, he says, "You look like you're in great health for a man your age." And it's like this expansion is in good health for an expansion its age. But we're going to print a CPI number next week, which I think is going to be 2.6% year over year. We've got a 4.2% unemployment rate. You add those two numbers together, that's better than the combination has been 85% of the time in the last 50 years. There's nothing wrong with the economy. And I think the most important thing for the Federal Reserve to say is, look, it's the problems underneath in different groups, but overall the macro picture is pretty good, and the Federal Reserve just wants, or should want, just to sustain it.
So playing around with theories, our friend Mark Dow suggests they go 25 and they can tolerate a descent for 50. Would that make sense?
Yeah, well, of course they can tolerate a descent. I think that I will say one thing that Jay Powell's done very well is he tends to poll all the members. He tends to try to argue and see if they can get them all together. And I don't think there's anybody in the committee who's going to be so strong in favor of 50 to really push the needle. So I'd actually be surprised if we've got a dissent. I think we'll get 25 across the board. And I think that's what he's arguing for right now.
It's almost more important what he signals going forward, because the market still prices in 100 basis points by the end of the year. So is the market going to be disappointed if they just do a few 25s?
I think the funny thing is I think the market will be relieved. The bond market might be disappointed, but I think in general the economy and the stock market will be relieved. If the Federal Reserve can say 25 basis points, we think the economy is fundamentally healthy, but there is no call for monetary restraint right now. We're going to gradually ease rates back to normal. That is a very positive message for the market. So I want the bond market to be disappointed.
David, important day. Appreciate it as always coming in and helping us understand the numbers. Thanks.
Sure, anytime.
Good to see you.